Hello everyone. Welcome to Pile Investing channel to achieve financial goals and freedom. Today we will talk about the greatest investor of all time, Warren Buffett. He discovered the fourth law of motion in perspective with Sir Isaac Newton. We'll come later Warren Buffett's fourth law of motion. If you don't know about Newton investments portfolio story, let's discuss a little bit about it. Sir Isaac Newton, 1642 to 1727, was a brilliant and greatest scientist of all time. But you can't be wrong if you say he was a pretty lousy investor. His investments were diversified and profitable at one point of time. But then, late in life, he placed nearly all of his wealth into the stock of one company. The company's name was South Sea. In 1711, British government restructured the debt load. Basically, it was the deal of conversion of government public debt into equity. British government called the bondholders to exchange their securities into South Sea Co shares. During this time, dividends were paid on the stock at a lower rate than interest on bonds. However, the potential for dividends increases and sizable capital was gained when Parliament gave the company a monopoly on trade with Spain's colonies in South America. Newton started to invest in stocks in 1712. Over the next 8 years, he picked up more companies' share using his savings and the proceeds from selling his shares to other companies. In 1720, he converted his government bonds and all annuities into the South Sea stock. During British government bond conversion to South Sea shares, in other words, meant the higher South Sea stock climbed, the fewer shares needed to be issued in exchange for the debt, and the greater the company's profit. There was speculation, rumors, and incredible tales about South American gold, silver, and other commodities just waiting to be imported back to Europe. The South Seas stock was also made easier to buy. The price of South Sea coal stock shot up in 1720 from £128 in early January to £350 in April. At this point, Newton's share profit crossed more than £20,000, about $4 million in current US dollars. The stock kept soaring. Newton jumped back in during June and bought more shares. The share price was £700 a share. Shortly after, the price hit £800, making the company worth twice the value of all the land in England. In the summer, news broke that insiders were selling. The stock began to tumble and within few weeks plunged all the way back to the £200 level per share. So ended the infamous South Sea bubble. According to Professor Andrew Odulisco research in the Royal Society Journal of the History of Science, Newton ended 1720 with a third less capital, his portfolio consisting mostly of South Sea shares. The South Sea Co remained in business, but its share never regained the glory before Newton died in 1727. Professor Delisco estimates that if Newton had bought and held his South Sea shares continuously from early 1712 through 1723, when the stock stabilized after the bursting of the bubble, he would have earned a cumulative total return of approximately 116%. That's about 6.5% annually, not counting dividends. A generous return at a time when long term government bonds carried interest rates of 4% to 5%. However, Newton didn't buy and hold continuously. Sir Isaac Newton's investment portfolio and his decision led to his failure because he did not stay the course for the long term. Isaac Newton did not follow the great investor Warren Buffett's strategy of buy and hold long term. The fourth law of motion is return decrease as motion increase. For example, every investor hopes to make money from stocks. If one stock buy a lot of investors, the price will increase and the chance of making money from the stock will go down. Warren Buffett wrote in 2005, long ago, Sir Isaac Newton gave us three laws of motion, which were the work of genius. But Sir Isaac's talents didn't extend to investing. He lost a bundle in the South Sea bubble. Explaining later, I can calculate the movement of the stars, but not the madness of men. If he had not been traumatized by these laws, Sir Isaac might well have gone on to discover the fourth law of motion. For investors as a whole, returns decrease as motion increases. Thank you for watching this video. Please subscribe Pile Investing channel and stay tuned in for our more upcoming videos weekly. We study value investment, successful investment case studies, financial freedom, economics independence, billionaire minds, books, and many more. See you next time with more inspirational and value investment educational material. Thank you.